Good evening, traders and investors. Will back here with another one, coming to you with a Wednesday market recap. Hopefully you guys had a very good day in the markets today. And in today's action, well, it was a very big day, of course. That is not reflected so much in the gains or losses of the SPY and the QQQ. But what did happen today is something historic, of course. You have a Fed pivot. Now, the Federal Reserve has cut interest rates by 0.25%. And although we don't have that much reaction in the markets in terms of pricing right now, we did get a lot of information from it. We were seeking to understand today whether or not the Fed was going to cut rates in a dovish or hawkish manner. Were they worried about the economy, or was it more of an accommodative rate cut? As a matter of fact, it was the latter, an accommodative rate cut. As a matter of fact, Jerome Powell went so far as to call it a risk management 0.25% cut. So that was very interesting today as well. We also got to learn that the market had perfectly priced in the remaining amount of rate cuts for the end of the year. 2 more to be specific. So in today's video, guys, we have a lot of things to recap. Number one, of course, we will be doing a bit of a deep dive into the speech by Jerome Powell today and the summary of economic projections by the Federal Reserve. What is their stance on the GDP rate over the next year, the unemployment rate, the inflation rate, and the path of interest rate cuts? We'll do a deep dive on that in part number 1 of today's video. Thereafter, we will be doing a full index review in terms of the technicals. Where do we stand on a day like today where the SPY, the QQQ are slightly negative? We have several sectors here that had a really good day, namely financials, healthcare was doing pretty good, even consumer defensives. So we will take a look at the rotation and possibly derive where is the money going to be flowing after a day like today? Now, obviously, guys, you can't really expect institutions to slosh around hundreds of billions of dollars in the last hour and a half of the trading day after the speech, after the report comes out. No, most of that positioning will be coming in the next few days and into the next few weeks as well. You also have to remember that there is currently $7 trillion of money on the sidelines parked in money market funds. And that money is not going to move until the rates actually come down. And it makes perfectly sense. If you can just sit on the sidelines and earn about 4.5% risk-free, you're probably going to do that. But as rates come down and as the interest rate approaches the rate of inflation, well, obviously, there's not much money to be made just sitting in a money market fund, so that money will slowly but surely start to be reallocated to equities, of course. And today, now that we have a confirmed path of rate cuts by the Fed, we also know that several names individually in several sectors will be benefiting. So in today's video, we are going to take a look at the indexes, but also take a look at them in the aspect of how can rate cuts possibly impact these to the upside or to the downside as well. Thereafter, we will do the exact same thing on our big tech list name right here. A lot of big tech was kind of struggling today, so we'll have a look in today's action which one of these companies or which some of these companies are going to be good buying opportunities still for either some swing trades or some long-term portfolio positioning. And yes, of course, at the end of the video, we will be taking a brief look at our biggest gainers and losers of the day, of which, of course, today there were many. Very volatile day. Some names switched places from red to green, green to red all throughout the day. So we will take a look at this list right here and possibly derive the best trade opportunities amongst them, considering the fact that rates are now going to be coming down in a significant fashion over the course of the next 6 months. And that's going to be it for today, guys. So it should be a very fun video, and let's get right into it. So the SPY down about 0.12, the Q's down about 0.2, but all things considered, guys, it was a fairly decent day when you look at the broad market picture. Take a look here. You'll see that big tech was largely unfavorable today, but that's okay. As I keep mentioning when we talk about rotation here, guys, when big tech chooses to take a little bit of a holiday, you kind of need the rest of the market there to kind of make up for the loss of that weight. And today was indeed a day like today. Financials performing well, healthcare performing well, consumer defensives performing very well too, and the bottom half of the market, although mixed, did have a slightly green bias to it. Although big tech were some of the biggest losers today, the rest of the market was definitely there to kind of pick up the slack. In terms of the one-day relative, defensives, financials, utilities, healthcare, and communication services making their way into positive territory. To the downside, sadly, technology, your biggest loss leader of the day. On the 1 week relative now, well, as we currently stand, all market sectors are performing decently to the upside, and even the ones that aren't are just basically flat to slightly down, talking mainly about healthcare, which has just been kind of flat and sideways for the last 3 weeks. Real estate, surprisingly, real estate had a massive jump after Jerome Powell specifically started speaking, but after the Fed released the report at 2 p.m., that's when it started. And then while Jerome Powell was speaking initially, it had a further pop, but then kind of gave it all back. So although the price action on real estate was awkward today at best, we do still have some bright opportunities for some of the real estate plays in the next coming weeks, in the next coming months, in my humble opinion as well. So before we get into more price analysis here in terms of price action on the SPY, the QQQ, and everything under the sun, let's take a look at what exactly happened during that Fed meeting today and take a brief look at the summary of economic projections too. Well, here you go. Fed meeting recap. The Fed Chair Powell calls the quarter-point trim a risk management cut. So talking about risk management cut, as I was saying in the introduction, the whole premise of today was to determine whether or not the Fed was worried about the state of affairs of the economy, the labor market, inflation, and everything in between, or whether or not they were just going to try to accommodate the markets by reducing financial pressures with the byproduct of dropping the interest rate. Well, it was, as a matter of fact, known as a dovish cut. Jerome Powell called it a risk management cut. If you want to use a synonym to that, that is an accommodative rate cut to begin with, right? So here's some of the headlines. Here's what he had to say. You can think of this in a way as a risk management cut. He added that a very different picture of risks has emerged as the labor market has begun to cool off versus the threats on the inflation front. So he spoke a little bit during the Q&A session and during the pre-prepared remarks about the fact that, yes, inflation is slightly on the rise as a result of tariffs, but that it might just be a one-time affair. Additionally, in terms of the labor market, he once again reiterated the sentence that he said at Jackson Hole, calling it a no hiring, but also no firing economy right now. We still have a lot of jobs available in the economy as viewed by the JOLTS jobs reports, 7 million jobs to be specific, but not many new jobs are being added to the economy, and we can see that in the weakness in the non-farm payrolls recently and all of the revisions that happened on those non-farm payrolls for the last 3-4 months as well. However, the unemployment rate right now is not skyrocketing, thereby, referencing the sentence, it's a no hiring, no firing labor market. But Jerome Powell does not want it to get any softer. Moving on further, we have begun to see goods prices showing through into higher inflation. And actually, the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the inflation over the course of the year. So no services inflation, that's really good for housing. Most of the inflation has come from goods and has been a byproduct of tariffs, but still nothing meaningful yet. They're not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. But the key word here is slowly. Moving on further, Powell says that the consumers have felt a small impact from tariffs so far as companies are eating the cost increases, right? So not much of that's been passed on to the consumer so far. Companies are choosing to eat that in the profits as of right now. To the consumer, the pass-through has been pretty small. It's been slower and smaller than we actually thought. So that's actually very good. Moving on further here, I think I have one more here. The data shows the softening labor market and rising inflation. While the unemployment rate remains low, it has edged up. Job gains have slowed and downside risks to employment have risen at the same time. Inflation has risen recently and remains somewhat elevated. However, we are not in some form of a stagflation scenario. No, the GDP growth rate is still too high to reference any notions of stagflation right now. Inflation is steadily trending higher, but not that fast. And as we said, the risks to the labor market are probably now outweighing those of inflation. So the takeaway from today, guys, is the fact that contrary to what the Fed has been doing over the last roughly year and a half, they can no longer adopt a stance of neutrality and data dependency. No, they have to be proactive. And as a result, you have the first of many quote-unquote risk management cuts. If you take a look at the summary of economic projections right here, it was actually pretty good. So you can see the June projections in terms of GDP showed us at a 1.4% GDP rate through 2025. That's been upticked to 1.6. Very healthy. The GDP ratio predictions for 2026, that has moved up from June till now from 1.6 to 1.8. Very good. So apparently the Fed deeming that the economy is in a better landscape than previously previously established in June, possibly because the tariff impacts are not as heavy as they might have expected. Now, in terms of the unemployment rate, that is also something that we really have to key in, and that did not move. Still 4.5% by the end of 2025. 2026, though, showed a small downtick from 4.5 to 4.4. I'll remind you, low fours, guys, is still very historically low unemployment, so that also is a very good aspect. In terms of inflation as well hasn't moved for 2025, both on the normal PCE read, but also on core. You can see them pretty much landlocked here at exactly the same rates as the June projections. However, we do have a small uptick into 2026 from 2.4 on PCE to 2.6. And the same thing on core from 2.4 to 2.6 as well. So that is referencing Jerome Powell's comments that although the inflation pressures from tariffs have not been felt just yet, they might be expecting more in the coming months and possibly into next year. But once again, keyword is slowly. The biggest takeaway today, though, is of course this, the federal funds rate predictions. And as you can see, they are much better than the meeting in June. June still saw us at a 3.9 on average interest rate by the end of the year. That has now been cut down to 3.6. What does that mean? That means that with today's rate cut, you possibly got two more, one in October and one in December. In terms of 2026, that has also been guided down from 3.6% terminal rate to 3.4%, and 2027 longer rate runs from 3.4 to 3.1%. All very good things. So if you take a look at the probability watch here from the market and the Fed are penciling in two rate cuts by the end of the year. There's only two meetings remaining before the end of the year as well, October and December, both in excess of 80% probabilities. In terms of next year, this is where the Fed and the markets are kind of at different lengths right here. In terms of the summary of economic projections, the Fed, most members are only penciling in one interest rate cut. Now, if you take a look at the dot plot, you will see that many members are penciling in a lot more than one interest rate cut, with about half of Federal Reserve members being in or around the lower 3% range, which would be another 3 cuts. But we still have a lot of people up here kind of sticking around the 3.5 to just under 4% range, which would be additionally one simple extra cut or no cuts at all in 2026. So you have a lot of really broad Fed positioning right here in terms of the dot plot for 2026. If you ask the market what they think, the market is still pricing in roughly 2 to 3 interest rate cuts for next year. And the reason why we didn't feel so much of an impact on that in terms of prices today in the markets is simply because there's a lot of time, right? The market is usually very accurate in terms of pricing in the next 1 to 2 meetings, but of course the data is going to change a lot over the next 2 to 3 months. And as a result, if the labor market, kind of starts to fade a little bit more, well then of course you would give more credence to the probabilities of 2 to 3 interest rate cuts in 2026 rather than just one. So what they're trying to do is they're trying to get a little bit ahead here, 3 cuts for this year, and then maybe kind of just stand back and pause and wait to see in terms of inflation and wait to see about the jobs market. But for now, they can't wait and see anymore. They want to be proactive and they want to do that risk management cut. So that is the kind of summary right now of what happened today and why it impacted markets in the way that it did. If you ask me my opinion, I thought that this was fairly good for the markets, fairly dovish. I mean, if you take a look at the summary here of projections, GDP was very good. Unemployment rate was very good as well. PCE inflation didn't really show much changes by the end of this year, only slightly into 2026. But once again, that's open to interpretation. They don't know that that's going to happen, and neither do we. We will just have to see how that inflation trickles into the economy in relation to the impact from tariffs. So all in all, guys, without wanting to predict too much beyond the next 2-3 months, I thought that this report was fairly good, and I do believe that equities will react in a very nice fashion to it. But as I said, positioning in the last hour and a half, 2 hours of trade for a lot of big retail investors or large institutions is probably not going to happen. You can't move hundreds of billions of dollars in an hour and a half, 2 hours before the market close. More often than not, a lot of these institutions will do their analysis over the course of today, tomorrow, at the end of the week, and then derive some potential positioning patterns. And you'll probably see those more and more over the next few days into the next few weeks as well. So today's price action was largely flat, but you can see the futures market right now responding very well, as we can already see some overnight positioning from international markets. Of course, Asia and the London session as well will be coming alive throughout the course of the night, and those guys as well will be positioning as a result of these Fed interest rate cuts. That is currently what you're seeing right now in the post-market or pre-market, depending how you look at it, right? So moving on to the QQQs, they're up about 0.5% in the pre-market, post-market, and then the S&P 500 is up another 0.31. All in all, though, guys, very solid report. I'm pretty happy with it, and you guys should probably be happy with it as well. So that's everything we had for that big introduction, that big recap for rates, but I felt that it did need to be done just to give you guys some context behind it. Now, let's dive into the indexes, because we got a lot of work to do here in terms of driving potential areas of interest. So in terms of the price action, I mean, very clearly, the bulls are still in control. We came right back down here and tested the 12 EMA, which I was saying in the most recent few videos, that would be the first line of defense for the bulls, and it seems as though it played off today with the market's big green right now in the pre-market session. Well, you would not be surprised if we just simply continue on to this rally. If you crack into a new all-time high territory right now, this becomes your new daily high or low, and the daily uptrend simply continues at this point with a new line in the sand level at this point established around 654. All in all, the bulls looking healthy, and even if we were to somehow roll over this move and people interpret this negatively over the next couple days, couple weeks of price action, who's in control here? Definitely the bulls. You would just be looking for a nice, healthy retracement size into some more recent higher lows. The bigger support level for the S&P is down here 640 to 634. On the QQQs right now, same concept as well, right? Very nice price action on the QQQs right now. Daily higher lows are trying to be set right now by the bulls. If they crack onto a new all-time high tomorrow or Friday, you can officially say this is indeed your new line in the sand level, and the daily uptrend simply continues. If we pop and then roll over and breach this guy, well, that is a daily downtrend just started, and of course, you'll just be looking for very healthy weekly consolidation, possibly down into the 12 EMA, 567, or into the lower area of support, which is 562, down about 555. So very decent, guys. It's still a market in which we should be looking for our favorite companies across the planet, whether that's big tech names or some thematic names in relation to rate cuts. It is, in my opinion, still a dip buying market right now. Just be patient and always let the market come to you. If you want to take a look at some of your market breadth indicators, they're actually not doing too poorly at all. The percentage of stocks above their 20-day EMA is currently sitting at 51.5% right now, which is not the highest read, but not low by any standards right there, kind of just in the middle. But we've been noticing that over the course of the past, let's say, week or two. The market wasn't so broad. Big tech was doing a good job of holding up the gains as much as they could, but there was a lot of apprehension leading into today. You might be able to see a broadening out of the market, which would be kind of synonymous with the price action that we saw today into tomorrow's actions, as many more sectors than only tech will be favored by this interest rate cut path. Percentage of stocks above their 50-day EMA, which is the institutional gauge of bullishness or bearishness in the market. Below 50, institutions are bearish and net sellers in the market. Above 50, they are still net buyers. So right now we're sitting at a cool 60%. And percentage of stocks above their 200-day EMA, that has not moved in the last 3-4 weeks, right? Still very healthy right now, though, at about 60%, but you can see some further broadening out of the market and some further expansion on your longer term timeframes, so please keep all that in mind. Now, moving into the first of many sectors that could heavily benefit from the rate cuts, we're going to talk about XLF financials, right? So it's very obvious why financials are going to stand to benefit from the rate cuts. Number one, of course, the banks. The banks will benefit from gains in net interest income, not because the interest rate is coming down so much, and that will impact their bottom line in terms of the difference that they can issue loans versus what they can acquire loans from the Federal Reserve at the overnight lending rate. No, it's just because the demand for loans will probably be going higher and higher over the next few months, next few years as well. So I'm expecting the banks to perform fairly well. In terms of today's price action on some of the banks, it was fairly good. JP Morgan really breaking out higher, so any back tests on JPM down here of the lower 300s could be a very nice buying opportunity in my opinion. Visa and MasterCard, they will stand to benefit as well. Obviously, we know that credit cards run a variable interest rate. They do drop percentages a little bit, but when the overall interest rates fall, people usually feel a little bit more rich in terms of the buying power that they have in terms of discretionary spending, and you might just see an increase in volume across the board. Visa is still at a fantastic location. We've been talking about this location for the last few weeks, 340 to 330. I think Visa right now arguably is one of the best plays in the entire market in terms of just a company that's extremely profitable, very consistent as well, and could benefit from that whole theme of financials getting a bid after the fact, right? And then there's a lot of mortgage companies such as Rocket Mortgage and others, right? Rocket Mortgage could tend to do very well. I know there's been a lot of bullishness around this stock recently, but I do still think there is more on the table over the next few months and over the next few years as well. As the mortgage market kind of opens up, we know that it's been very dry, to say the least, over the last 6 months. Some of these mortgage companies could perform very well in the near-term future. In terms of your healthcare sector right now, so healthcare was a bit muted today. They actually popped a lot while Jerome Powell was speaking, kind of gave it all back. Very tight range of consolidation right now. The line in the sand levels are about 136 at the lows. If you lose those, sadly, you're going into a bit more weekly consolidation, but we know the bulls are looking pretty good right now. We're consolidating above the highs of this previous resistance range, and eventually we are looking for that next leg of expansion, which could take us into the 140s. I still like healthcare. Healthcare has been beaten down, out of favor, you know what I mean? So healthcare is still one of my favorite sectors to play. It's not the fastest moving sector, but I do still think it's more on the sure side of things than not in terms of expansion over the next few months. It's not so related to interest rate cuts. It's just something that's been left behind. On to semiconductors right now. Semiconductors pulling back a little bit. You had some big losses on NVIDIA and stocks like AMD throughout the day. They were able to get some of those losses back to the end of the day, but it was a consolidation day for a lot of semiconductor names, just to be general. Now, in terms of the price action, daily uptrend is very nice right now, looking for a nice daily higher low. And at this point, you have a nice support area, 300 down to 295, which the bulls seem as though they want to kind of use as a fallback area for a good old breakout, retest, and run trade. There was some phenomenal entry opportunities for some short puts with increases in volatility into the afternoon. NVIDIA and AMD, just to name a couple of the ones that we were looking at in our Discord chat, and that we were able to also fire off some trades with that volatility and with those slight price declines. So semiconductors still looking quite good. Moving on to the Russell right now. The Russell up only 0.26%. Look how much the Russell came up during that Fed meeting, right? It actually rallied 1.31%. From 2 p.m. to 2:30 p.m. And then Jerome Powell started to speak. They kind of started to pair off all the gains, but it's fine, right? The Russell's still in a good position here to benefit from some interest rate increases, or rather from some increases in price on small caps in relation to the decreases in interest rates overall. The daily uptrend is still looking fine right now, but if you had one chart and one chart only to really focus your attention on, it should be this weekly, right? In the event we have a bit of a sell down here, which would be contrary to what you would expect from an interest rate cutting cycle. That's when you have a price discrepancy, right? When something should be going up because of the macro, but it's pulling back, that's when you know there's a bit of divergence. And that's when we know that we can possibly position into that divergence. 230 down to 225 would be the area that I would be curious to position in the event that we get that on the Russell, as we know that many sectors in the Russell will be benefiting. About roughly half or over half of names in the Russell are just non-profitable companies that run a lot of debt. So there will, of course, be a lot of debt refinancing into the pipelines soon for a lot of these companies. And while I'm on topic, I should have done this during financials, but while I'm on the topic here, some of the companies that'll benefit from, debt repricing are not so much the companies that have a lot of debt. That's one aspect of it. But another aspect of it, as I keep saying, guys, Moody's and SPGI. Watch out for these, right? Because there are arguably no better companies in the market to benefit from all of this debt that needs to be repriced, refinanced, and have a new credit rating associated with it than Moody's and SPGI. They'll be having a tremendous amount of business over the next year or two. I still think these are some of the better plays in the market. SPGI, classic breakout retest and possibly run right here. And Moody's Corporation, the exact same thing. Nice breakout retest and possibly looking for the run. Fantastic companies to possibly position in. They're not the fastest moving companies, but they will benefit tremendously from this rate cutting cycle overall. Moving into XLP right now, consumer defensives. Not the worst area to position in. Probably my favorite one to position in right now would just be Costco, accumulating more Costco shares from the $950 down to about the low $900 range. It's been an area of support, arguably, for the last year. Costco really hasn't done much. Sure, they've expanded a few times, but in all reality, we're just kind of stuck in this price action range here, which looks oddly similar to the same thing that we had into 2022 and into 2023. So if Costco keeps tightening up here, I will be a big fan of buying some of my favorite consumer defensive names, and it all starts with Costco for me. Moving on to utilities. Utilities, guys, I think will be a big beneficiary of the rate cutting cycle that we are pretty much going to embark into soon. Weekly, looking for a bit of a backtest again down into here, into the 82, 83 area, down to about 81 area. Utilities could be really interesting, guys, right? Talking about names like VSP, talking about other electric names associated with possible rate cuts, talking about names like, let's say, Duke Energy, right, as well. Fantastic company that might be able to benefit from some of these rate cuts. Now, we know a lot of people just pay more attention to names like SMR and Oklo in terms of power generation, and that's fine. But in the event that you wanted to play the more defensive nature of utilities and only wanted to go for the power generation companies, I still think that they stand to do arguably very well into the next 6-12 months overall, as more money will be allocated to them now that the risk-free rate is coming down. Moving on to real estate right now, our last sector that we have to analyze for the purpose of rate cuts. Well, this one seems as though it's the most obvious one, right? So there's a lot of names that we can possibly play in real estate. We brought up the mortgage companies earlier when we took a look at financials, but also you have to keep in mind that there's a lot of REITs that haven't really done much of anything recently, right? Vici has been kind of locked in the range here for the last 3-4 years. Names like Income Realty Corporation also have not done much of anything in the last 4 years. So REITs are not a bad place to position. We also have some fantastic companies in real estate, such as CBRE, which really got ahead of the market right now. Any pullbacks on this one could be very interesting for a swing trade. If you don't want to play individual companies, you can also play the entire sector, which would be XLRE. It's been consolidating here largely since the month of December. Very nice area of support, and this is going to be a longer duration play, something that could just start slowly expanding over time. But as I said, it's more on the sure side of things than not. So not everything has to be fast moving, very volatile plays. You can have some of these more, let's call them defensive, slow-moving names that are more sure bets, because they have been lagging behind the market for a considerable amount of time at this point. And my two favorite ones would be XLV, XLRE, and possibly even some pullbacks on the home builders, right? We identified the home builders trades correctly down here for some pre-positioning into interest rate cuts. So whether you're trading XHB or ITB, which is the home construction ETF, some very nice back tests could be had, guys. And if you see some further declines on some of the home builders, it could be very interesting to possibly further position into the home builders. It's not a very fast trade, but it is a trade that could come alive over the next 6, 12, 18 months as the real estate market starts to really, well, just essentially not be dead anymore, right? Starts to come alive progressively, but we know the real estate market moves a bit slower than other markets. So this one is really a thematic play over the course of the next, as I said, 12, 18, 24 months type of thing. Now, if we take a look at the VIX down about 4.03%. So today's volatility was not enough to keep the VIX higher. The VIX kind of tried to run ahead of the Fed meeting, but sadly fell flat on its face for now. And we don't really have any more volatility catalysts for the week. That was it, guys. Tomorrow, not much of anything. And on Friday, we don't have anything at all whatsoever. If we take a look into maybe next week, in terms of what volatility catalysts could possibly move the VIX, well, we don't have much, right? Manufacturing and services PMI, that's fine. We also have GDP for Q2, which is also going to be largely above consensus estimates, still showing very strong numbers too. Got a bunch of Fed speakers next week, and then we also have core PCE and PCE. The expectations of those are not to be crazy jumps in inflation. If you take a look at Trueflation indications right now, currently standing about 2.26%, which is not the lowest, but it's also not a very high read objectively. So arguably, guys, we don't really have much in terms of something that could pop the VIX higher. So we might just stay in a low volatility environment until some big data point really changes and scares the market. But as of right now, there are none. So still a nice environment to essentially be buying the dips and maybe explore some leap call options on some names or some themes that have been left behind when the volatility is low. Moving on to the 10-year and 20-year yields, these actually had a bit of an awkward day, right? The reason that they came higher after, well, you can see it spiked lower initially, and then it actually ran a little bit hot. So the reason being is that there was some discrepancy here in terms of longer term projections. And when I say longer term projections, I'm talking about 2026. You remember me saying that there was some, awkward positioning here amongst Fed members for 2026, not as tight as 2025, right? Kind of all over the place. So there's a discrepancy between what the Fed members were anticipating here and what the market has been anticipating for 2026. And as a result, since these 10 and 20-year yields are longer duration, well, they're not going to move as fast as something like the 1 and 2 year with immediate rate cuts. So the pricing on them was somewhat awkward today, but I would not be surprised if the downtrends continue on our yields here. It might just be a little bit bumpy, but I think the downtrends are well underway right now, which also means that TLT may have bottomed already. As a result, any dips can be further accumulations for this name right here into the first take profit zone. Any buys down here, if we have take profit areas, this is number 1, 93 down to 90. And then the higher end here, 100 down to about 97 is take profit area number 2 for some of those TLT trades overall. It's not going to be a fast moving trade, but it is one probably that is going to move with an upward bias here into the end of the year probably. Moving into gold right now. So gold, not too bad of a day on gold. It was down about 0.81%. And gold is a bit of a tricky situation right now because gold has many faces, right? Gold can either be a risk-off trade, gold can either be a inflation trade, or anything in between. It can also just act as an asset in which people buy because they're bullish on assets overall. So it's always tricky to determine what face is gold have, what face does gold have right now, right? What narrative does it want to play? The one thing that's for sure though is this price action. The daily higher lows are set right now down here at about 36.07. In the event that you unwind this and trigger a bit of a daily downtrend, you're just going to be looking for a very healthy weekly higher low. And that's kind of the move that I'm looking for right now. I'm not really looking to play a further leg of expansion on gold. I think we're pretty rich right now in terms of the daily RSI, and in terms of the weekly RSI, we're kind of getting up there again as well. If you do have a pullback here to the 12 EMA though, call it under 35, I'll probably be a big fan of playing this strategic pullback on gold, of which, we've had many. Keep in mind, this 12 EMA on gold, whenever it rallies a lot, is a nice little fallback area. That would be a swing trade location for myself personally. And now lastly, moving on to Bitcoin and Ethereum before we get into big tech. Bitcoin and Ethereum, they didn't really do too much yesterday. You would have expected a bit more volatility, but nothing much, right? We're still kind of continuing on this nice daily uptrend. You can see that in the overnight session. Bitcoin is actually pushing into resistance right now, 117 up to 120. Very nice daily uptrend. And in terms of the weekly as well, guys, this was a weekly downtrend, but we were saying, well, when the bulls got the daily uptrend back, here, well, the end of weekly consolidation, at least for this leg, was finished, and now we need to look at the size of the bounce. Size of the bounce was really good on Bitcoin as of right now. It's about a 618 bounce. So even if you get rejected from here, guys, from resistance, and you kind of embark on a bit more consolidation, what are the bulls going to be looking for? We're looking to change this weekly trend, right? Either in a two-step process, or they might just go for the big engulfing move overall. One thing's for sure, two things are for certain. If it comes back here again down to 108, I will once again be selling put options, once again building some position trades as well into Bitcoin in terms of just accumulating some more Bitcoin essentially. One of the names that's lagged behind though is MSTR. Right? MSTR has lagged, and usually you do not see this big, well, it's not that you don't see it, but usually they don't last too long. There's been a big divergence here between Bitcoin and MSTR. If I just plot Bitcoin versus MSTR right now, you can see it all started happening here, right? So Bitcoin largely stayed flat with a downward bias, but MSTR came down a lot more throughout this leg right here. And now that Bitcoin has been rallying for, let's say, the past, about 3 weeks of time, MSTR has done nothing, which is very good. Sometimes I do like playing these divergences. So I'm accumulating some MSTR down here, and I'm looking for it to kind of play like a rubber band and catch back up to its normal price action for Bitcoin. Sometimes it takes longer than expected, but usually it always does transpire. Moving into Ethereum right now, Ethereum also not looking too bad at all. The bulls are going for the new daily uptrend break. That will be a break of 47.50 to the upside. In the event that we just unwind and that doesn't happen, for example, well, the clearest timeframes, as I've been saying for the past few weeks, are the weeklies. In the event you unwind this to the lows, you're looking for a back test down here, 4,000 to 3,700. Ethereum is not looking too bad. My favorite proxy for playing Ethereum right now is going to be BMNR. I've been, I was accumulating some shares of BMR down here, but I usually always like to run the wheel strategy as well, selling puts below the market on this name. I think Tom Lee and Peter Thiel and his team of super investors that he's kind of acquired into this fund so far are really great salespeople. And when you're talking about treasury funds, their price can go up two different ways. Number one, well, obviously the price of ETH goes up, and as a result, the treasury is holding ETH, so the treasury price goes up as well. The other way is they are going to kind of get more and more people to buy into the fund. And there's probably no better sales team than the one that Tom Lee has put together at BitMine Immersion Technologies. So that is also going to be another factor there. That's why I play this one. I do not play other ones like SBET or things of that nature. I just think that, Tom Lee and his team will be able to acquire a lot more direct investment than anybody else in the game right now. And that's everything for your overall market rundown. Hopefully you guys appreciated that with a bit of a rate cut twist. Now let's move into our big tech names. So if you take a look at Apple right here, Apple up 0.35%. Apple still battling with the 240 psychological level. Still no break with the bulls trying to protect this daily uptrend right now. But it's very awkward, right? Very awkward wide range. One thing's for sure though, the weekly charts show a very clear picture of who's in control. It is of course your weekly bulls with your line in the sand levels still being set down here at about 225. They're looking good. They're trying to protect this and trying to go for the next leg of expansion, which could really take you into the 250 and then 260 all-time highs. So although the price action on Apple has been somewhat awkward, the chart still looks good, and I will be playing any and all pullbacks of Apple if we have some quick and sharp pullbacks into the sub 230 range. You will find me selling some put options into the mid 225s. No swing trades for me on Apple right now. I just do not think the risk reward profile is there, at least not for some level to level trades, right? If we have a stop loss there and a take profit here, that's kind of equidistant risk to reward. That's why I was a fan of building some positions there to carry into this level. That was good risk to reward, right? Now, not so much, but if I had any shares, I also wouldn't, I do have long-term Apple shares. I don't really see any reason to sell. The pre-orders for the iPhone 17 and other products have been pretty good so far, so I'm expecting a good Q3 for Apple. Moving on to AMD right now. AMD, a little bit challenging today, 0.81% to the downside. At one point today, it was down 2.25. That being said, guys, the bulls are trying to go for this daily uptrend, but they almost lost it. Line in the sand is down here, 154.78. If you lose this, you're down into another daily downtrend. The bulls are going to get rejected here into resistance, 171 to 156. And as a result, you are just still into another just set of weekly consolidation candles. So that being said, the next area of support below us, 148 down to 133. Today and any day, which sees AMD pull back into the low 150s, is a phenomenal opportunity to be selling some puts down here under the market. And additionally, as we are moving into the 150s and possibly, I'm not sure, but we'll see, into the 140s, it's a good opportunity to be accumulating some shares and some longer duration positions as well. I think the growth thesis on AMD is very clear here in terms of fundamental expansion over the next few years. I do not think it is too late for AMD. I think they still have two of the best years, ahead of them. And as a result, I am still accumulating some AMD positions in this area. Moving on to Amazon right now. Amazon down 1.04%. At one point, they were down close to 2% today. But Amazon, let's be honest, they've just been doing a whole lot of nothing, right? The bulls are trying to go for the daily uptrend expansion, but they've just been kind of trapped in this range for a while, right? The weekly chart looks kind of awkward right here. One thing is for sure, though, if we do pull back into this location, talking about the under 230, like mid 220s, you will find me selling some put options on Amazon down here in the 220 range. But also in terms of accumulating some Amazon shares, guys, I'm still a very big fan, right? Keep in mind, a lot of these big tech companies, they're not really going to be impacted by the rate cut decision today. Why? Well, quite simply, guys, they don't have that much debt at all, right? Not even close. They're very cash rich. And as a matter of fact, while interest rates were high, this is where a lot of the big money was hiding because they can absorb the impacts of high interest rates. That being said, the only thing that does impact their valuation is when analysts run discounted free cash flow models or other types of financial modeling. When you change the risk-free rate, obviously that is going to impact the model the most. So sure, you could see some re-ratings in terms of price targets for these stocks just because the discounted cash flow models or other financial models will give them a bit of share price appreciation. But that is it, right? They really do not stand to benefit the most from the rate cuts, but obviously they won't be hurt by them either. So I'm still a very big fan of accumulating more and more and more Amazon shares down here while we have the time, because I do think that eventually this chart's going to look like Google. This one's been fairly slow recently. We know that, year-to-date performance, Amazon is one of your weaker performers, only up about 5.58 when the rest of the market is up huge. But I think this is probably the next stock to play some big catch-up, so I do want to make the most of this consolidation range. Moving on to Google right now. Google down about 0.62%, but I mean, let's be honest, it's completely normal. The bulls are on the moon with this one right now, looking very pretty right now, and any pullbacks just looking for a new higher low. Maybe your 12 EMA could be a first area of interest for any short form pullbacks. On the weekly time frames, the bulls are still in full control, but we are peaking into the 80 RSI range. And if you go back historically and identify every time that Google has kind of peaked into these 80 RSI ranges, well, that has been synonymous with some forms of local top. So just please keep that in mind for this current stock right now. That being said, if we pull back on the weekly, how much space do the bulls actually have? The short answer is an absolute ton, right? You're just going to be looking for a natural higher low. It kind of looks like Microsoft. So I did say that when Google does start weekly consolidation, meaning when they lose the daily uptrend and go into daily consolidation and go into consequential weekly consolidation, it might look like something like a Microsoft. 4, 5, 6 weeks of downside. Not very crazy downside, but downside nevertheless until the bulls find a short-term local bottom. Moving into Meta right now. Meta actually not with a bad day, 0.42% to the upside. Daily uptrend is now confirmed by the bulls. Your line in the sand, daily higher lows are set at about 744. Looking good for the expansion. Next price target for Meta, of course, is going to be 790 all-time highs. Well, let's call it 796, and then of course 800 psychological. Looking quite good here on Meta. No concerns whatsoever, 775. Beautiful weekly uptrend as well. The bulls are in full control. And in terms of positioning for some longer term shares, Meta for me right now, guys, is a nibble. It has been a nibble this entire range, call it 770 to about 745. After or before earnings as well. Very solid earnings, very strong company. It's not a heavy buy. The heavier buys for me come at the lower $700 range. Not sure if we're going to get it, but the valuation here does definitely support some upside. If you ask me my price target on Meta by, let's say, like 2027, Meta can have a good chance, guys, of being like $1,000 into 2027, right? Probably towards the later stage of the year, but there's a lot of meat left on the bone for Meta, of course. No red flags for the business at all. Talking about Microsoft now at the current time, 0.19% to the upside. Microsoft was actually down today. One clear thing the bulls are looking to do, though, you guys remember this? Sweeping daily downtrend, couldn't get it changed for like 5, 6, 7 weeks. And now you got a nice engulfing move. The bulls are trying to go for the daily uptrend shift. So looking pretty good on Microsoft right there. You got a daily MACD, which is also curled over after the last 5, 6, 7 weeks of downside momentum. And the bulls are just looking to kind of continue on where they started off for a next new leg of weekly expansion. You know, you never know if it's actually going to go for the full expansion or if it's going to end up like something like Netflix, right? Just get a nice little bounce underway and then just consolidate sideways into the valuation. Those two things are on the table. However, if the worst case scenario for Microsoft plays off, which is a weekly downtrend and flush of the lows, just always remember what we're going for here, guys. You're just going for very natural monthly consolidation. 470, 460 would be an area for me to play Microsoft. Nothing for me right now, though. On Netflix, the bulls are still defending 1215 to about 1185. Not much to do here on Netflix. I mean, if we wanted to take some swing trades with a stop loss below our most recent lows, 1185, 1180, for a possible recapture of a daily uptrend into a weekly breakout trade with the rest of tech, let's say, that would be quite normal. Your stop loss would be down here, 1180, and your take profit would be weekly and monthly expansion, right? Back into a nice weekly uptrend. It's a bit of a longer duration trade, but the risk reward definitely makes sense. First take profit range, right, would be 1340 right here. And then the second one, you'd have to go with something psychological like 1500. Netflix, I mean, for me here, guys, Netflix is like a nibble, right? Where it becomes a bigger buy is like $1,100 to $1,000. That's when I start buying into it a bit more heavy, but it is a nibble. So with my paychecks every single month, I buy into the market once every month, beginning of the month. I have like, let's say a certain amount, let's call it like $3,000 that I allocate to all of my companies. Some, when they're really overvalued, in my opinion, I just don't allocate to that month. Netflix has been getting DCAs when it's in the lower 1,200 range. The only time it didn't was when it was peaking above 1,300. So I am still buying incremental shares of Netflix, but nothing huge. If you guys wanted to know how I'm doing it. Moving on to NVIDIA right now. NVIDIA at one point today was down over 3%. One of the better buys in the market in terms of selling some short puts under the market right now. Daily downtrend, nice 786 retracement by the bulls right now, and sadly they're giving back a lot. But the bulls are not going to roll over yet. The whole 171 down to 165 is a nice area of support. We will see if they can get it done. And if not, if they keep sliding and we go into some form of weekly downtrend and more weekly consolidation, which would lead you into monthly consolidation, no problem at all, guys. Probably one of my favorite stocks in the market right now to be selling some short puts into the mid 150s range, as we are anticipating this very healthy monthly pullback to probably result in a next bull leg higher, possibly at some point into the next 2, 3, 4, 6, 12 months type of thing. NVIDIA is probably not done, and the valuation down here at 175 is still quite manageable. So this is an area that I would be looking to maybe accumulate a couple more shares if this was something I was looking to build for the expansion phases into 2026 and 2027. Moving on to Tesla right now, let me just check the time of the video. We're not too bad today, but I did talk a lot about rates this morning. So Tesla obviously is one of the beneficiaries of rate cuts, not because they have a lot of debt, but obviously because of the car industry, guys. The auto industry has been, well, let's just say very soft coming out of 2021 into 22, 23, 24, and 25. Companies are taking a lot of hits in the margins, and Tesla is as well. They are subsidizing interest rates for leases and also financing, and that does impact corporate margins at the end of the day. So Tesla right now benefiting from those rate increases, but also, of course, the news that Elon was buying $1 billion of stock just the other day, looking quite good, right? The bulls have now backtested, well, almost backtested this lower $400 range a couple times right now. Not too bad for Tesla, right? If you pull back a bit more into it, talking about 400 down to 380, it could be a nice little area to build some swing trade longs. Not some heavy longs, but you would be going for level-to-level trading, looking for weekly higher lows, and then you'd be going for the expansion, call it 450 onto the all-time highs, 486. So Tesla, looking not too bad. I will give it to him, right? Congratulations to all the Tesla bulls right now. I still have not as many Tesla shares as I used to, but I still have a position on Tesla. So, you know, it's working well. But Tesla has always been a question of you kind of got to ignore the short-term negatives, which is really hard for some people to do, and focus on the long-term positives, which is really easy for some other people to do, right? Very polarizing stock, to say the least. Moving on to Palantir right now. Palantir was down 1.13% today. However, at one point today, guys, Palantir was down 5%. This was also a nice area at some of the peak lows when we got the news release at 2 p.m. into 205, 210. There was a one little trade opportunity for some short puts on Palantir here. Down here, 138 for next Friday. They were giving 0.5%. It was under the range of support. If you were looking, you would have found it, but obviously it's not there anymore, and that trade is now significantly profitable. So Palantir Bow's looking good. What are they doing? They're backtesting. Backtesting what? This whole range of accumulation that we kind of came out of, 162. So going for the breakout, retest, and possibly run. If we wanted to position for a short-term swing trade on Palantir, this is how we would do it. We would assume that the low of today, the volatility lows, and the FOMC flush was the final back test for the bulls to possibly mount a rally recovery. That being said, if we wanted to position on Palantir, stop loss below 161, because if that drops, it invalidates and you get trapped back in the range again. You're looking for the expansion into where? Possibly into the 189, 190 range. Not a bad risk to reward profile on Palantir, but that's the only thing that I see on the company right now. Other than that, the bulls are still in full control of this weekly time frame. On to SOFI right now, which is a stock that I did trade today when SOFI was down 3% initially at 2 p.m. after the press release. Well, we could find some very attractive short puts into next week. 24 and 23 fives were available. This was on the top 5 options list for this week. But I was saying also, if you can't find them for this Friday, pay attention to the ones for the following Friday, especially if you can find in this area, which is nice support. And we actually did. We were able to get the 23 fives for 22 cents. 1% for the next week, and now that trade is already 50-60% profitable. So the bulls are looking good right now. They're in good shape, right? We're going for a daily higher low, trying to go for expansion, backtesting the 12 EMA, and backtesting some of your prior range resistance highs, which are now support. Not the biggest, but they are there, right? On the weekly, the bulls are obviously still in full control of this chart, and even if you unwind a little bit, fantastic opportunity to be selling some puts down there and accumulate, if we go into this area, accumulating more SOFI shares, as in around 25, the valuation is still quite manageable. Long term, I'm a big fan. I'm holding all my SOFI shares right now, not really selling some, but if you guys are running some call options right now and your call options are expiring like in October, as I know a lot of people's are, October, November, December, you should kind of be progressively winding down a lot of those gains, even if it can run more into the end of the year. Try not to hold the full bag on things. Take profits progressively as you run out of time on some of those call options. Or if you want to be tax efficient and follow SOFI into, the next year as well, and those call options are making a lot of money for you right now, you can also consider the ever so rare exercise of some of those options into shares, defer your tax obligation, then just ride the shares into 2026 and 2027. That is also what some of our Discord members are doing. Moving into Uber right now, Uber down 5% off of some news that Lyft just acquired a partnership with Waymo. Not too bad for Nashville, Tennessee, launching in 2026. So Uber, sadly coming down off of that, guys. But at the end of the day, right, Uber is a much more massive company. Uber has had its fair share of own news releases with Waymo and so many other robotaxi partners. But this is good for the overall landscape, right, of the ride-sharing services. You really love to see that. That being said, Uber is down today. Is Uber a buy at the lower 90s? I personally do believe so. At $89.90, you're trading at a forward price to earnings of about 30, PEG ratio 1.17, and a very attractive free cash flow yield with a ton of buybacks still to be done by the company right there. And we're just consolidating, right? Uber hasn't really done much of anything, let's just say over the course of the past, 2 months or so, 3 months or so since June. It's just kind of just been range bound here at the highs, which is not the worst thing. If it does come down a bit more, you will definitely find me selling puts into the mid 80s, looking to play the wheel strategy down there. In terms of buying Uber shares, personally, I'm acquiring just some with normal DCAs because the valuation is still good, but I'm not like bulk buying Uber right now. Just very small nibbles in terms of just regular DCAs. And finally, TSM. Finally, TSM. TSM up 0.28%. Not the worst day for them, but they also suffered from a bit of decline here early day with the semiconductor landscape. Now, that being said, if we pull back a little bit more, you're just looking for a new higher low. Anything above 226. So much space for the bulls, guys. Looking for a higher low. And even if you unwind this daily uptrend, let's say they do something like this, right? You see it coming. Daily downtrend, what are you looking for? Very natural weekly consolidation. This could be one of the best breakout retests in the entire market in the event that it happens, right? You never know if it's going to actually retest, but keep an eye on it. Any declines, selling some put options down here, sub 240, but also if we actually come down into the air, getting some swing trades going for expansion into 2026. Very solid proposition there on the chart, in my opinion. Fundamentals, fantastic for TSM, one of my favorite companies in the world, arguably, but especially in the semiconductor landscape. And that is everything I had for you guys for the overall market rundown. Now, of course, we got to get to everybody's favorite section, which are the biggest gainers and losers of the day. Okay, so I know I say this every single video, but we're actually going to run through these quickly today, but we'll pay special attention to some that are coming down and that might be interesting opportunities for the rate cuts. BLDR. BLDR, guys, one of the best, in my opinion, home construction materials company. This one is going to be a potential long, but it's a long that you might need to be a bit patient with, right? It's a long that could look something like this, right? It's been a monthly downtrend for the longest time right now. The bulls have a nice bounce going right here. Eventually, we're looking to set some monthly higher lows and possibly go for the rally recovery. That being said, the fundamental valuation of this company down here is really, really, really good. So BLDR will be one that I'm looking for, possibly to play a bit more aggressively, and well, not aggressively, but more frequently in terms of short puts, possibly down here under the 120 range. But even building some debit spreads or some shares to carry into the next 6, 12, 18 months. Not the worst proposition in the market. I will be paying close attention to it as part of the whole home builder / home construction trade. Uber, we talked about already. Symbiotic for me is a bid down here. If we can make our way back down a few percentage points lower and get kind of a nice fast drop right there, I'd be a big fan of playing this one. Short puts under the market into the low 40s. I think it's a nice pullback area. Nice support area in the past, and just would be an area of monthly consolidation, right? Phenomenal rally. Monthly consolidation for a possible further upside here. Beautiful robotics play, probably one of my favorite robotics plays in the market right now. Talking about Broadcom, there's nothing really to do on Broadcom right now, if I'm being completely honest. We're a bit too far away from an area in which we want short puts or any possible swing trades. Then you have the earnings gap. This one's kind of like TSM, right? If you come back and fill the earnings gap and touch the 12, maybe we can talk about some swing trades. But right now, Broadcom, it would just be a hold for me. If I'm holding shares or whatnot, I don't really see a reason to sell, but it's a bit tough to start a brand new position on Broadcom up here, as the valuation is slightly rich, as we were talking about after earnings. Not so rich that it's a categorical sell, but so rich that it's not like a full send buy right now, just a hold right now. Grab currently down, but Grab, we're gonna be looking for something here, guys. Grab really coming alive. Haven't spoken about it too much. If you get a back test down here, like 570, 560 into 550, could be a nice area to like build some further longs as we kind of do the good old breakout retest. I mean, how long has this range been here, guys? Almost a year, right? When you break out of a year-long range, you may only get one shot to go for the breakout retest long. Grab is looking pretty good for those purposes. If you take a look at Resolve right now, Resolve for me, this AI agent company that has ran, what has it done? Like a 3x almost in like 3 weeks. If we come down, I might just be looking to build a small call option position, out of the money call options if we can pull back down under 6 to 5. It's a lottery play, which is why I say small. If you wanted to build some shares, the best way of building some shares is possibly selling some puts under the market and acquiring the shares that way, or just progressively building to a certain dollar amount that you're willing to hold into it, and then you just let it ride, right? Looking for expansion targets thereafter into possibly 10, 12, which is the prior IPO price or SPAC price, as this one was a SPAC back in 2024. Moving on to SMR right now. So SMR, as part of the whole energy trade, this one I will be selling puts on lower 30s. Company has no revenue, but the same can be said about Oklo. It isn't a very favorable narrative right now, and I do still think the bulls are probably not going to roll over without a fight into the end of the year and into the rest of the AI narrative. So as a result, I will want to be playing this massive monthly pullback right here, 30 down to about 28. Speaking about narratives that we haven't talked about too much, names that are not on this list, take a look at these guys. Quadruple U's, right? Critical minerals. They're really starting to rally right now. So UU is gone. We were talking about this one a lot back here. Call options positions, they're now up a lot of money. Swing trades with shares or short puts. Now this one is kind of gone. You are pretty late. It's like last chance to dance right now. No partnerships announced just yet. Well, no investments rather from the US government just yet. So that's the final catalyst that you're looking for, but it really is like last chance to dance on this one. USAR is lagging a little bit behind, but this one is also a very interesting play. Lagging behind possibly for some out of the money call options, $20 calls, as long as you can find on the options chain, but small. These are lottery trades, right? Keep them small, nice back test. I've been playing some short puts as we pull back into these areas. Not looking too bad for some of the thematic critical minerals plays if you missed MP materials and you're looking for possibly some extra runners on top of that. Taking a look at Circle. Circle, in my opinion, is a accumulation trade down here and a short put trade, sub 120 into this support range. Accumulation for some shares that you might want to hold for a bull or base case scenario into 2027. You could have some nice share price appreciation to the upside, but we know that it's a battle across many timeframes right now, just an accumulation phase for the markets. I think that's it in terms of the ones that I wanted to cover to the downside, many of which we spoke about during the rest of the video, right? Taking a look at names to the upside, Open Door, obviously, right? Rate cuts, Open Door, it kind of goes hand in hand. That being said, this one is still a lottery play. Is it too late? Yes and no, right? The market cap right now, 7.51 billion. I'll remind you, it got a lot higher back in 2021 when there was a lot of hype. It can squeeze back to $15, $16, which is your next area. of logical resistance for this company. As a result, this one, once again, lottery. If you have not been in it this entire time and you want a position, are you late? Absolutely, you're late. Absolutely. So you would buy some here with the expectation that you will maybe have to buy more and final position down there, and then you just let it ride. You just let the macro tailwinds play out. You see if the company's actually able to execute on their business model, or you see how much Wall Street Bets is going to pump this one in a short amount of time. So there are several bullish catalysts for Open Door. At the end of the day, though, it is somewhat of a lottery trade, so only play this one with money that you're willing to lose. Speaking now about the other China trades, we were talking about China trades yesterday, right? Baidu finally coming alive, hitting some of the levels not seen since 2023. That was really fast. Speaking about Baba as well, Baba continues to be an absolute rocket ship right now. Some companies that have not rallied as much but might be coming up next are JD.com, and a name like Pinduoduo is moving well, but hasn't been getting the same lift as Baba and Baidu have been finding recently. Obviously, Baba and Baidu have the most exposure to the Chinese data center ramp narrative as they also embark into the AI wars right now. So that's why Baidu and Baba are having the biggest gain so far. But what it's doing wonders for is KWEB, the ETF. If you didn't want to play a company individually, you can always play the ETF. We had some call options from back here, but also from back here. And I've been holding these guys for a while, right? These call options, happy to say we finally took some profits on them into our resistance range target, which was the logical area, right? We've been targeting this range for the past 6 months. It's finally here, so we took some profits on those KWEB calls, but there is a case in point to hold this one for further take profits into the 50 range as we get more expansion from China. If we take a look at more other names, right, NBIS is, in my opinion, a buy for some DCAs still. The market cap is not too expensive right now. It's a DCA, but right now it's a DCA with some nibbles, right? You don't want to position too heavy up here. You kind of missed a bulk of the rally. We talked about NBIS back here. We talked about it here, right? And then after earnings. So these areas were heavier buys in my opinion. As of right now, it's either a hold or a nibble for me, but it's looking good. Iris Energy is the same concept. It's either a hold or a slight nibble for me. We talked about this one back here. We talked about it here right after their earnings, saying it might just be last chance to dance. And now the valuation is pushing, rich territory. So it's a nibble and or a hold just for me on these names right now. Talking about SentinelOne, probably one of my favorite cybersecurity plays right now. This one is also an accumulate trade for me right now. It's a buy just because the base and bull case scenarios give us some good conditions for some upside, guys. In my opinion, the risk to reward on this one is really good. It's also possibly an acquisition target at only $6 billion. There might be a bigger player looking to put in a tender offer maybe for the entire company soon. If not, they have the fundamentals alone to start recapture the levels up here in the 20s as cybersecurity recovers, because we know that cybersecurity has been doing okay recently, but nothing crazy, right? They are kind of net down in the most recent couple months, net down or flat. Even some of the bigger names, Cloudflare has been holding up the best, but you look at other names like Zscaler, nothing fancy here, right? The last couple of months have just been nothing but sideways or downside bias. Datadog as well is kind of caught in there. And my other favorite one that I've been building a position on recently is Rubrik. Rubrik, I think, is a really nice opportunity down here. Low 70s into mid 60s is the accumulation range for Rubrik. They had fantastic earnings, but this one was another one where they had great earnings, but similar to so many different companies over the course of this most recent quarter, they had good earnings. Everything was great, right? But still not good enough for Wall Street. They just sent them down regardless, but definitely not because there's a fundamental issue with the company right here. And I think that's it, guys. Honestly, like the credit card companies we spoke about, these will be net winners here. I'm not buying any more American Express up here. I bought all my American Express that I ever could have wanted throughout the tariff dips, this last location, and now it's just kind of time to ride the shares. Visa is probably my go-to right now. If I took a look at other things, PayPal might be interesting right here for a bit of a swing trade long, but it's a very slow stock. The valuation is very low, though. You got to give them that, right? The valuation on PayPal is like dirt cheap right now. So this one could just be like a set it and forget it trade, right? It's not the sexiest name right now, I will agree, but it does definitely look like it has some upside associated with it right now. Mercado Libre is a stock that is a buy for me. It was a buy for me yesterday. It was a buy for me last week. It's been a buy for me for the last 2 months. Accumulate the long positions as the valuations and forward growth prospects are very, very strong for Mercado Libre. And I think that's it, guys. We'll keep it short and sweet. We will take a look more tomorrow at some positioning and how it affects all of these stocks. But hopefully after today's video, you get a good sense of kind of what we're looking for, the themes we're looking for, and where you should be looking as well. Big tech is probably still going to be a core focus, with a special emphasis on names that haven't ran as much, such as Amazon, and especially some of the semiconductor names on some pullbacks, talking about AMD and NVIDIA, things of that nature, right? Not so much trying to buy Microsoft at these highs or trying to buy Google at these highs. No, still trying to target names on pullbacks into our levels. That probably will be the most favorable aspect of the market, still big tech, but now we're starting to see some themes come alive across financials, across real estate, utilities with some of those energy plays, etc., etc. So that's everything I had for you guys for today's video. Hopefully you enjoyed. If you did, consider dropping a like. Would appreciate it for the growth of the channel. Consider subscribing if you're new. We do these every Monday to Friday after the close. And last but not least, if you guys have any questions, please feel free to leave them down below in the comment section, and I will always be glad to answer. And lastly, in the event that you guys wanted to join a community of traders and investors such as yourself, where we have over 250 other members in there that trade the markets every day with me, but we also build very high quality long-term portfolios, you may consider joining our Discord community. In the community, you get access to a few things. Number one, of course, you get access to all of my trades in real time, whether those are the wheel trades, whether those are the directional trades, such as leap call contracts, which we've been crushing this entire year so far, debit spreads, credit spreads. Here's just all the trades that we've made over the course of the last few months. The green little check marks are wins. The red little circles are losses. I like to keep my wins pretty big and the losses pretty small. So you get access to all those trades in real time, but you also get access to our private morning live streams Monday to Friday, where I stream live at the open for about 2 to 3 hours every day. I trade live, but I also take all your questions on your stocks, your options, and your long-term portfolios. So if you want to interact with me directly and you want me to help you out with certain things, it's the best place to do it, because I can give you some real-time chart analysis, options chain analysis, and anything in between, fundamentals, all that good stuff. A lot of people learn there. Our members, guys, have been crushing it. I wish I could show you, maybe with their permission, one day I'll show you the success channel, but I don't want to reveal anybody's usernames if they don't want me to, type of thing, right? But members have just been crushing it this year so far with all the knowledge accumulated, not just from my trades, but just from what they've learned and being able to take their own trades based off of that as well, right? But everybody's been having fantastic performance so far. So congratulations to all of you guys that are in the Discord with us. You guys have been crushing it. Love to see it on a daily basis. You also get access to our educational section content, in which I provide, videos on technical analysis, fundamental analysis, various trading strategies, especially with options, how to grow a trading portfolio, how to grow a long-term portfolio and build a long-term portfolio. So much educational content that our members have been using to their advantage to really build bulletproof long-term portfolios, but also to keep crushing those trades day in, day out. And you can also ask me all your questions in our chat rooms throughout the day, and I'm very fast to answer. You can also copy all of my charts whenever you see support resistance levels here, fundamental breakdowns, all of my watch lists. You can literally just copy paste them. I let all my Discord members just copy paste everything that I have. It makes their lives a bit easier. So those are just some of the benefits in the Discord. If any of that sounds good to you, I would love to have you in there. And so would the rest of our members. You can make some good friends, have some good fun in the process as well. The link to the Discord is down below in the video description. Hopefully I see you guys in there soon. And if not, I'll see you right back here on the channel. That's it for me. Hope you guys had a good day today. Hopefully you guys crush it in the markets tomorrow as well. Take care. Always remember, don't chase the market. Let your preferred names come to you. And I'll see you guys tomorrow after the close. Peace.